Fantastic. Well, I think let's get stuck in. Always takes a little couple of minutes to get going. Respectful of your time. Don't want to run over today. Um, yeah. So welcome everybody to the first quarter 2026 markets call. Markets obviously weak. Sentiment is down, pretty depressed, and yeah, there's some structural concerns that deserve attention. And yeah, but the weakness often causes people to lose attention, not want to look closer. And so the real goal here is to just pay attention to what's going on. Uh, Hopefully that'll be of value to all of you. Obviously, as context here, none of this is investment advice. You're always welcome to contact me directly if you want to have those type of conversations. And also, obviously, for those of you who don't know, my name is Rob Price. I'm from Sound Money. We're an actively managed crypto fund. We're hosting this call today in conjunction with our partners, Currency Hub, one of the largest crypto arbitrage firms in South Africa. And yeah, what we're going to cover today is brief reflection on the last quarter. So the last call that we had that many of you joined us on, and we talked about the macro challenges where we have got that macro induced weakness. We'll chat through some of the structural concerns that are reverberating around the market at the moment, related to gold, related to quantum computing. And then we'll just take a look, cold hard look at what we're seeing in the markets at the moment. We've seen a leverage flush, seen a capitulation event, sentiment is depressed. And for us, the perspective on the market, the risk reward trade-off has changed. Please do stop me if you have at any moment, if you've got any questions, if I'm going too fast, if you want me to slow down, explain anything. Really want this to be valuable for you. So I know we've got a broad kind of spectrum of different attendees. So just let me know where you're at in the chat. I'll check every now and again to see what's on your mind. So yeah, as we mentioned, the last quarter we had our call, I think mid-November. We chatted about the macro challenges. Macroeconomic conditions have been weak, and it caused us to be more cautious. We said it was unlikely that Bitcoin was going to have a great return profile on those type of conditions, and that's what we've seen play out. We chatted about this short-term holder cost basis. That's basically the price at which the recent buyers purchased at. We said that price would need to recover back above that level for conditions to be more constructive, or else things would be more challenging. And in reality, the experience that we had is price here in the orange. We did see a recovery, post November, particularly into January, but that short-term holder cost basis worked as resistance, really. The price struggled at that level in the mid to high 90,000s, and we've seen a sharp sell-off ever since. Price is now 50% down, notable correction from the highs. We've retraced the gains since the Trump election victory in the States. And the victory was in 2004, inauguration in 2005. And as I said, sentiment is obviously challenging. We'll touch more on the market conditions in a moment, but I thought just good to update relative to what we spoke about at our last call. Right, as I mentioned, there are some structural concerns that are keeping some people awake at night. So let's go through those. The one is on the gold front. So I mean, Bitcoin is a store of value asset. They're the two preeminent store of value assets in the world are gold and Bitcoin. And there's been many periods of time over Bitcoin's life, the last 15 years, where it's overshadowed gold. But that's not been the case over the last year. Gold has significantly outperformed Bitcoin, and that raises question: raises questions about why we're seeing this divergence between these two store of value assets. I think the first point that I think is useful to note is that, as a broader context, the correlation between these assets is never particularly strong. So expecting them to perform in tandem is unrealistic. So that's useful to know. Um, this is just contextualizing that the 5-year returns from gold and Bitcoin, and Bitcoin has outperformed most of the time, but over the last 5 years, it's been more challenging because of the weak 1-year returns. So what's causing the divergence in performance between these two store of value assets at a time when market conditions generally are pretty supportive for store of value assets with a fair amount of geopolitical, monetary, and fiscal instability? Well, the key reason here is central bank gold purchases. So this is just a graph looking at those over the last 3 consecutive years. We've seen of 1,000 tons worth of central bank gold purchases. And that's an astronomical amount of flow. I mean, you can see it's pretty much double what we had in the previous time period. And by contrast, Bitcoin is not seeing the same level of flows. We did see a Bitcoin strategic reserve, which I think was a big deal, but it didn't result in any net new purchases of Bitcoin in the US. The only country to be actively purchasing Bitcoin is El Salvador. It's obviously a pretty small nation. So there's a stark contrast here. And, one day I would expect that governments are buying Bitcoin, but for the time being, the reality is that governments have turned back towards the tried and tested, the asset that they know, the asset that they already hold in reserve, the asset that they also dominate a fair amount of the market. And so, we just have to, face up to that reality. Bitcoin obviously got the ETFs, which were launched in January 2024. And there's been large flows into those ETFs, very successful. But nevertheless, the numbers would pale in comparison to those central bank gold purchases. So it's obviously a good story here, the flows into ETFs, but from a relative perspective to the sovereign sector, that is a different picture. Now, listen, we give a lot of thought to both of these assets because, as I said, they're both store of value, sound money assets that fall into our philosophical framework of sound money assets. And the way we see it, I mean, Bitcoin still has a significant number of advantages over gold. It is scarcer in supply. It has, I would say, less centralized control. We've mentioned that central banks do dominate a significant portion of the gold market. And then on the technical front, it is easier to store and to transfer and to audit and to trace Bitcoin transactions. So they're much more made for the digital age. They also have built-in payments capability. But it's interesting to note that there is a contrast here where, yes, Bitcoin is digital. You can use it on the internet. It's easy to store and self-custody. It's easy to send to anyone, any time of day. If you're looking to send large amounts of money to the other side of the world, there's really no better technology than using Bitcoin. But the other side to that coin is that Bitcoin, while not reliant on companies, it's not reliant on governments, it is reliant on the underlying cryptography which governs it. And gold, by contrast, this hunk of yellow metal, is quite simple from a technological perspective. It's just reliant on geological and physical properties. And in the last 6 to 12 months, this contrast between gold and Bitcoin has raised some interesting questions about are there any risks to Bitcoin's underlying security through its cryptography? I'm just jumping to the chat. I see from Rafael a question about short-term holder cost basis. That was, back a few slides. That's just the price at which Bitcoin's last actually traded. So that short-term holder cost basis, we're looking at, the recent buyers of Bitcoin. When did they buy it at? So this question about quantum. So, Bitcoin, from a technological perspective, has said it's reliant on the underlying cryptography. At the moment, with current computing, it's incredibly, incredibly secure. Now, with the advent of artificial intelligence, the rapid advancement there, it has raised questions about when we might see a new step change in computing. So quantum computing is something that people thought was very far into the future. The timeline is still very uncertain. It's still in the future. But the rapid advancements we've seen has raised the question, is that time frame slightly shorter? And it is possible with quantum computing that it starts to threaten some of Bitcoin's underlying cryptography. Now, important to note here that it's not just Bitcoin's cryptography. Quantum computing could threaten all security systems. Banks, insurance companies, governments, anything where you're trying to keep information secure on a digital basis utilizes cryptography. And Bitcoin, like other systems, can upgrade to a new signature technique, which is resistant to quantum computing, right? The question here, the real key is, how does Bitcoin upgrade and how does that contrast relative to a centralized system? So Bitcoin is a decentralized system. That is one of its major advantages. It can't be influenced, tampered with by centralized intermediaries. But there is this downside that from an upgrade perspective, it's more challenging because you need to get consensus amongst the participants. Whereas in a centralized system, it could be easier to execute those type of upgrades. And there is some concern that we haven't seen as much attention paid to this by Bitcoin developers as could otherwise be the case. Now, I mean, they are paying attention, and we can see that, but the risk has just been elevated, and that's quite evident here. This is a Google searches for quantum computing and Bitcoin. Well, it's gone through the roof in recent months. So I think that there's a reasonable argument to make here that it has caused some investors to be concerned relative to where they were in the past. And that, as I said, does contrast relative to something like gold, which is physical and security is simpler. It has all these challenges of transportation and auditability, but it's quite simple and physical. So Maxim's asking about whether Bitcoin is still scarce, given that you can subdivide it so significantly. So, I mean, I think it is. So that would just be equivalent to saying, you could also potentially subdivide, rands or dollars. So you might use 1 rand, but you could use 10 cents, you could use 1 cent, and theoretically you could use, if a rand was so valuable that fractions of a cent were of value, you could theoretically do that subdivision, but that subdivision wouldn't actually impact the supply. That 1 rand is 1 rand, $1 is $1. You can divide it into 100. You could theoretically divide it into 1,000. Obviously, banks are not going to recognize that because there's no value in it. But if there was, it would be something we theoretically could do. So, as I've mentioned, we do have these kind of more structural concerns coming to the surface of the underperformance of Bitcoin relative to gold, and the quantum concerns that have shortened in time frame. They're still far into the future, so this is not an imminent risk, but it's something that people are paying attention to. And I think it's also interesting to note that often, I'm not dismissing these concerns. They are real concerns. That's why I'm bringing them to your attention. But often narrative does follow price. and people can get more concerned with things when price is down. And of course, if price was up, people would be paying less attention to these things. So I think it's just useful to bear in mind that contrast. And for us, these kind of structural concerns, they don't override the cycle dynamics. We, of course, pay attention to them, but the cycle dynamics for us are more important. So as we mentioned at the start, we've clearly, seen this 50% retracement, excuse me, in price over recent months. And this is starting to resemble a capitulation event. So what we're looking at here is the realized loss on Bitcoin holdings. People who've sold it at a loss, and we can quantify the degree of loss in Bitcoin. Now this is starting to this blue line is starting to rise quite sharply, and I think it will continue to do so over the coming weeks because it's a 30-day moving average of the data. But you can see how this is starting to resemble these other peaks in in losses, and these losses that they suggest a capitulation event. People who are selling at deep loss, kind of corroborating evidence here. We're looking at in this chart. We're looking at short-term holders. It's the difference between their. It's almost a sister metric of the short-term holder cost basis that we mentioned earlier. It's looking at the difference between the cost basis and the current price of the short-term holders. The short-term holders are people who bought in the last 6 months. And what you can see here is this has gone very low, right? That suggests that short-term holders are deeply, deeply underwater. Those type of conditions, once again, tend to resemble these times in the market where price is very weak. So you can see that for yourself historically. And I said the sentiment, you can feel sentiment is weak, but also you can even quantify it here. So this is Google searches for Bitcoin is dead. And it's up at an all-time, it was close to an all-time high recently. It's still close to an all-time high. And these periods tend to happen during Bitcoin bear markets. This is 2022, during 2018. Now, there's of course always a possibility that Bitcoin is dead, but I mean that would not be our opinion. It's a very resilient asset. It's been called dead many times in the past, and it's not our expectation that that's going to happen. Going forward. The key picture here is that sentiment is very depressed at the moment. And for us, and we're not making a prediction, we're just saying that it's possible that the major capitulation event has already happened. We've seen, if you look at historical Bitcoin cycles, this is in the 2022 cycle, we saw a big capitulation event in kind of mid 2022. Price was still weak thereafter. So listen, we're not predicting the price can't go to another low, but this was kind of the major capitulation event. FTX happened here in October, November, and price was, of course, weak again. But relatively speaking, that price reaction to the FTX event was actually quite muted. It was big on one day in 1 week, but that marked the bottom. So we're in a bottoming process. That's the way that we assess it. Similarly, if we look further back to 2018, we saw a capitulation event here in kind of November 2018. Price kind of did fall lower again over the coming weeks, but only marginally so. So once again, that doesn't suggest that the bottom is in. Price can still go lower, but we have seen a major capitulation event, and we expect that a bottoming process is underway. If we look at open interest, this is open interest on Bitcoin. It's come back sharply over over recent weeks. So I see Raphael is asking about altcoins. I think I'll come to altcoins a little bit later in the piece. If we normalize open interest, and also just context here again, I mean, open interest, that is an indicator of leverage, right? How much leverage positions are open on Bitcoin through futures. So, and here this is just, plain open interest, this chart here. Here we're just normalizing it by market cap to get a kind of different perspective on, and it's fallen even sharper. Some of the lowest levels on normalized open interest that we've ever seen. So there's been a real flush of leverage. It's a serious liquidation event. Another way to measure that is also the interest rate that is charged on perpetual futures. Just think of that as I said, a sign of speculative activity. When it's really high, then speculators are prepared to pay up to be long the asset. Right, that's a sign of intense speculation. Whereas when it's low or negative, it's vice versa. Right, then you actually are being paid to go long. And it's the shorts who are paying an interest to hold those positions. So this suggests to us that the market is kind of rebalanced to some degree. Implied volatility spiked up. I think this is actually a really positive sign. How Bitcoin trades often kind of waxes and wanes between the financial assets and an increasingly financialized asset class with all of these derivatives, all these instruments that are built on top of it. That's not a bad thing, but I think it also is encouraging when we do see these flash out periods and Bitcoin starts to trade a little bit more on its own fundamentals. And for me, this kind of uptick in volatility is a signal of that. This is an in-house indicator, which kind of brings together a few of the concepts that we've been chatting about here. It's called liquidation dominance. So it looks at liquidations. So liquidations is when speculators get taken out, when they get margin called and they get forced to close down those positions. And we're comparing the longs versus the shorts on the liquidations front. And it's this blue line. And what you see is it's spiked higher in recent weeks. That suggests that, well, not suggest that what the underlying data is telling us that longs have been taken out. They've been margin called. And by contrast, the shorts are sitting pretty. Now, this type of one-sided activity with this chart spiking to its highest levels on record, once again, that just tells us that maybe the market is a little bit one-sided here. And what I'm showing you here on the graph is there is a relationship to subsequent Bitcoin returns. Like all of our indicators, there's no perfect relationship. Doesn't mean that Bitcoin price will follow the indicator, but it just suggests to us that the balance of probabilities, the balance of risks has changed in recent weeks. And, we have begun to act on that, reallocating some of the cash that we, built up in the fourth quarter of last year. So we started the presentation talking about macro conditions. Macro conditions were the key factor causing us to be more cautious in the fourth quarter. So let's look at those again. And I think it's interesting to note that while this obviously has declined a lot, and that's why we responded to it, it's not anywhere near the type of levels that we saw in 2022 or 2018. So macro conditions aren't as restrictive as they were during those periods. That could obviously change. Macro conditions could continue to decline, and that would cause us to change our perspective. But at the margin here, that just actually thinks that causes us to be less concerned than we were in the fourth quarter. See, Raphael is asking here about what does it mean? So let's pull back the lens here for a moment. When I say macro conditions, that's the broader financial market conditions. So what the indicator actually incorporates is things like the US dollar, right? When the dollar is strong, that tends to be more restrictive for financial conditions, for risk appetite. It incorporates interest rates. Similarly, when interest rates are high, that's more restrictive for financial market conditions and risk appetite. We also look at the yield curve, which is a combination of interest rates. We look at money supply growth. We look at the deficit. But all of these factors are giving us an assessment of how restrictive or open financial market conditions are, and therefore what that might imply for risk appetite. And then for us, this is the cornerstone of our investment process, the most important factor that we pay attention to. And of course, the actions of the Federal Reserve are critical in driving financial conditions, macro conditions. And as we mentioned, in the fourth quarter, the Federal Reserve was quite restrictive. We were seeing a reduction in their monetary base, through the back end of last year. But that has changed into the new year. We are seeing the monetary base start to tick up. It's only marginal at this stage, but the Fed has also announced and resumed its balance sheet expansion, pumping $40 billion into per month into the market. This doesn't, it's not comparable to quantitative easing 1, quantitative easing 2, or COVID, but it is directionally supportive. It is a change. And also something I think we spoke about last time is, just another signal of these funding pressures. This was looking at the spread between SOFR, which is an overnight financing rate between banks, and other short-term interest rates that was spiking higher in recent quarters, and that type of price action has moderated into the new year, which just suggests to us that maybe macroeconomic conditions are not quite as tight as they were a quarter ago. There's also been talk, of course, about the new Federal Reserve Chairman, Kevin Warsh. Talk is that he's predicted to be less supportive of quantitative easing. So maybe kind of in the short term, from a sentiment perspective, that has been kind of negative on price action. But yeah, I remember, when Jerome Powell came into the position of the Federal Reserve chairperson, he was anti-quantitative easing at the start, and he, changed his tune. So yeah, the way we see it, macro conditions, they're challenging, but not comparable to what we saw in 2018, 2022. The Fed has begun loosening. So in the balance of probabilities, that's, just causing us to think about the risks slightly differently. So summing up what we're seeing here, the macro has tightened. A lot of that move is played out. It could continue to go further, sure. And, these structural concerns deserve attention. The underperformance relative to gold, the reducing timeline towards eventual quantum computing. These are concerns to be aware of and understood. But if we look at market conditions, we have seen a leverage flush. We are experiencing a capitulation. Sentiment is deeply depressed. Yeah, so for us, the risk reward has shifted. We're not making a prediction, but we think that we are in a bottoming process. And I thought maybe as kind of a last point to make here, I thought it was useful also to remind us another thing that we chatted about during the last presentation. I won't go into detail here. If you like detail, let me know. We can get onto it in a few minutes. But we chatted about how the allocation to this asset class is more important than trying to speculate about price. Obviously, price is interesting. Market movements are interesting. We focus on them a lot. But from an allocation decision, the percentage allocation that one has in the market is a more important question. What percentage of my portfolio belongs in a volatile asymmetric asset? What percentage of my portfolio belongs in an alternative store of value asset? For some people, that number might be 1%. For others, it might be 5%. For others, it might be 10%. And of course, there's certain, risk return trade-offs, upside opportunity at high allocations, and volatility consequences. But critically, what we mentioned is those lower numbers, you don't see big um, impact on overall portfolio volatility. So if you are the type of investor with, low single-digit allocation to the asset class, sure, any downside move like this is, of course, can be hair-raising. But look at the total portfolio as a full construct and see actually that volatility was absorbed. And hopefully, if you've been, invested for long enough, you will see what the historical upside impact has been on the portfolio. And if that also weighting has fallen down relative to target, it's potentially a time that, over the next, 3, 6 months to be thinking about, okay, maybe I need to adjust back to that target weighting that I had bet in, that I had in mind from the start. All right, I'm going to pause there and see if we have any more questions. Oh, there was one question. Raphael asked about altcoins. So the way that we think about altcoins is very much as high beta assets. That potentially is overly simplistic, but that's the way that we consider them in our investment process. What does high beta mean? That's like the S&P 500 is the beta, and then investing into Nvidia or Tesla is high beta. It's more volatility. It's going further out on the risk spectrum. So for us, other non-Bitcoin assets, Ethereum, Solana, they are high beta assets. There's greater risk in them. That's not to say that now is a bad time to make those allocations, but just for us, I think at this stage of the cycle, we prefer to be more focused on Bitcoin. And as confidence starts to grow, that yes, indeed, a bottom is in with high degree of certainty, then we would start to think about some sort of rotation potentially into higher beta assets. That's our kind of our blanket approach. But of course, that doesn't mean that certain altcoins are not performing well. For instance, Hyperliquid is one that's a real standout. That's a decentralized exchange. Trading volumes have continued to be really positive there, and Hyperliquid has managed to outperform Bitcoin in recent months. But on the whole, it has been a challenging time for high beta assets and altcoins. So another question here from Raphael about the macro indicator. What would it take to turn higher from here? We're looking at those underlying components. It would, take extended dollar weakness. It would take a reduction in interest rates. Uh, more Federal Reserve, stimulus, quantitative easing. Those type of things can, push more liquidity into the markets, and so those are the type of aspects that we'd be looking at. Um, so Gustav's got a question here about the weakening correlation between US M2 money supply and the Bitcoin price. Yeah, I mean, I think that kind of relates to, what, let's bring up the charts again here. So uh, there we go. Screen should be shared again now. So money supply growth is one component of our macroeconomic indicator. So it will have a similarity, not certainly not exactly the same. Um, and so, I mean, yeah, I think the correlation. I mean, these things can wax and wane. I still think that macroeconomic conditions are a key driver of Bitcoin, and I think the chart does bear that out. Um, yes, we've seen sharper weakness over the last year than potentially would have anticipated relative to the tightness in macro conditions. But Bitcoin is also a lightning rod to liquidity. And if liquidity were to come back into the system, I wouldn't be surprised if it were to outperform other asset classes. So another question from Raphael here about what it would take for governments to begin buying Bitcoin versus gold. Yeah, good question. I mean, what is holding back governments at the moment? Well, the institutional credibility that and the institutional knowledge that central banks have in holding gold is clearly is keeping them walking down that road. Um, I do think that the Bitcoin Strategic Reserve by the Trump administration is a big deal, but as I said, the lack of no net new purchases there is a challenge. I mean, if we were to actually see net new purchases, that could really start to turn the needle. That would be a very significant thing for the world's, largest country, to be taking that action. We need one of these large institutions to kind of take the plunge there. In some respects that doesn't seem that far away because we've got a huge amount of institutional credibility by the success of the Bitcoin ETFs over the last 2 years. But yeah, maybe yeah, that's it. Maybe it's the US taking that plunge. Maybe it's the removal of the Trump administration, but still a continued positivity towards crypto under a new administration. Potentially, Bitcoin has been brandished by the Trump paintbrush. It's difficult to know precisely. Fantastic. We have what time for one last question, if anybody wants to take a stab. So Hilton's asking about, just the price turnaround. I mean, listen, for us, we always try and veer away from predicting prices, thinking about probabilities and scenarios. I think the price can still go lower, but I think that the potential for, deep weakness relative to current price is lower. It's not impossible, but it's lower. Given all the factors that we've mentioned here. Um, what would I like to see to almost confirm that a bottom is in? Things like long-term holder purchases. That would be a really be a positive sign. An uptick in flows towards ETFs. That would be a positive sign. Um, Potentially some Bitcoin outperformance relative to gold and equities. Bitcoin and gold and these store of value type assets, they are very much momentum plays. And gold has, won the narrative. There obviously are reasons, and we've gone on into the reasons, but often momentum and narrative plays a big role. And so, some sort of shift in that momentum and narrative also could be, a contributing factor towards confirming that a bottom is in with a high probability. Fantastic. Well, it's really been great to have all of your questions. We'll obviously send through the recording in the coming days, and please, as always, feel free to reach out Wishing you a great rest of your week.